In this video, I am going to explain revised version of company final accounts. See, the company final account which consists two basic financial statements. First one is form of statement of profit and loss, and second one is balance sheet. In the old format, it has three divisions, that is trading account, profit and loss account, and balance sheet. It is in the form of horizontal form or T format. But here the revised version, that is as per the revised schedule 6, the statement of profit and loss and balance sheet have to be presented in the vertical format, that is in the statement format. So now I am going to explain each and every contents of statement of profit and loss and balance sheet. See the format. Form of statement of profit and loss. Statement of profit and loss of name of the company for the year ended 31st March every year as per revised schedule 6. Here we have three columns. First column for this is content, the content of statement of profit and loss, and here you need to record the working note number. Each and every content you need to have a separate working note, and here you have to mention the working note number for each and every content, and here you need to write the net amount of each and every working note, and finally you will be getting the profit or loss for the period. See, when you prepare the final accounts, here you need not show any calculation. In the statement of profit and loss and balance sheet, you need to record only the net amount. The final amount will be recorded in the statement, and you need to record working note number also. Now I am going to explain each and every content separately. So first you have to start with the revenue from operation. See the working note. Notes to accounts on statement of profit and loss. So before you prepare the profit and loss statement, you need to have a working note for each and every contents. So I told you, the first one is revenue from operation. See, revenue from operation means the main sources of income of a company. See, for example, if the company is a manufacturing or trading company, means their main sources of income is net sales or gross profit. So if you have gross profit in your trial balance, means you can directly record gross profit, or else you can write the net sales. Net sales means after deducting sales return, you will be getting the net sales. That will be recorded in the statement of profit and loss. For manufacturing and trading company, gross profit or net sales will be the revenue from operation. In case of service company, fees earned will be the main sources of income, that is revenue from operation. If it is a financial company, means interest earned or dividend earned will be the revenue from operation. So according to the nature of the company, you can write any one. If it is manufacturing and trading company, means net sales will be the revenue from operation. If the gross profit is given in the problem, means you can directly record gross profits. Either gross profit or net sales will be the revenue from operation. So this will be recorded in the statement of profit and loss, working note number 1. Here you need to write the total revenue from operation. Net amount will be recorded here. If there is any sales return, that will be done in the working note itself. Here you need not show any calculation. You need to write only the net amount. Then second one is other income. So in an organization, there is a possibility of other income. Other income means the income which is not received from the operation, from the main source, is called other income. See, working note number 2, other income. So these are the examples for other income. For example, the company gets any amount by way of sale of fixed asset. It is not a main sources of income. So it is also comes under other income. Interest earned on fixed deposit. If it is a non-financial company, they have deposited some amount, in that way they are getting some interest. So it is also one of the income, but it is not a main sources of income. This will be recorded in other income. In the same way, interest on investment, dividend earned from the other company, discount received, commission received, export subsidy and duty drawback, a refund of income tax, excess provision returned back, etc. So these are all examples for other income. These are the examples of income which is not earned from the operation. So these are all called as other income, which is not comes under the operational income. So this will be recorded in the working note number 2. And after finding the total other income, this will be recorded in the statement of profit and loss. These are the two things which comes under receipt, that is income. First one is revenue from operation, means main sources of income, and apart from the main source, if the company earned any other income, that will be recorded under other income. Both will be added and the total revenue will be called as A. Now let us see the expenses. See, the first one is cost of material consumed or purchase of stock in trade or changes in inventories of finished goods, work in progress or stock in trade. You may have any one, either cost of material consumed or any one of these things. Let me explain this clearly. In the manufacturing and trading concern, the main expense is cost of material consumed. Okay, so here you need to calculate cost of material consumed with the help of this formula. See, the first one is you have to start with opening stock of raw material, and you need to add any purchase made during the year. If there is any expenses related with purchase, that will be added along with the purchase, that is carriage on purchase, carriage inwards, other expenses incurred on purchase of material. So all those items will be added along with the opening stock of raw material, and then if there is any purchase returns, that will be subtracted, and finally you need to subtract closing stock of raw material. So this amount is called cost of material consumed. So if it is manufacturing or trading concern, means you need to find cost of material consumed, and finally this amount will be recorded in the statement of profit and loss. See, other than the manufacturing concern, they won't be having any cost of material consumed. So in that case, you need to record purchase of stock in trade. Stock in trade means goods purchased for reselling. They acquire the stock and they resell it. In this way, they can get the profit. So in that kind of organization, they need to record the purchase of stock in trade. So this is not applicable for manufacturing concern. So other than manufacturing concern, you need to record goods purchased for reselling. That will be recorded here. Okay, in case of other companies, those who are having inventories in different forms, for example, inventories of finished goods, work in progress and stock in trade. So if you have inventories in 3 different forms, means you need to record the changes. If there is any changes in the opening inventory and closing inventory, that will be recorded separately. So there is a possibility of getting positive value or negative value. If the opening inventory is greater than the closing inventory, means you will be having positive value, that will be recorded outer column. If your opening inventory is lesser than the closing inventory, means you will be getting negative value, that will be recorded in the outer column. So whether it is a positive or negative, that will be shown in the statement of profit and loss. So according to the value, you can add or subtract. So far we have discussed the first point, that is under expenses you need to write cost of material consumed or purchase of stock in trade or changes in inventories of finished goods, work in progress or stock in trade. You may have any one calculations. So according to the nature of the organization, you will have any one calculation. Next expense is employee benefit expense. So under expense, first one is cost of material consumed and second one is employee benefit expense. See working note number 4. So any amount payable to employees, that is in the form of wages or in the form of salaries, that will be recorded in the 4th calculation. If there is any outstanding, so any outstanding expense, that will be added along with the respective expense. Here I have explained wages, that is outstanding wages. In case of prepaid expenses, that will be subtracted. So this rule is applicable for all expenses. Here I have explained only one thing, that is wages. So wages, salaries, bonus, leave encashment, gratuity paid, medical expenses for employees. So these are the different expenses which is related with the employee benefit expense. All those expenses will be recorded under the employee benefit expense. The final amount will be recorded in the statement of profit and loss. If there is any outstanding or prepaid, that will be adjusted here itself. You need not show any calculation, any addition or any subtraction in the statement of profit and loss, and the final amount will be recorded in statement of P&L. Next one is the 5th one, that is finance cost. See, finance cost means cost incurred by the company on its borrowings comes under this head. That is interest on bank OD, discount on issue of debentures written off, interest on debentures, interest on term loans, interest on public deposit, and interest on bonds, interest on cash credit. So these are all expenses which is incurred for its borrowings, for companies borrowings. So these are the different component which comes under finance cost. So this will be recorded in the statement of profit and loss. Next one, depreciation and amortization expenses. Working note number 6. Depreciation means this term is applicable for all fixed asset, but the term amortization is just like a depreciation, but this is applicable to intangible asset. For example, goodwill written off, a preliminary expense written off is called amortization. Both are similarly same nature only. So depreciation and amortization. See, working note number 6, depreciation and amortization expenses. That is depreciation on building, depreciation on plant and machinery, loose tools, furnitures, computer, goodwill written off, patents written off, preliminary expense written off. So these are the expenses which comes under depreciation and amortization. The depreciation is calculated under the asset, and after calculating the depreciation, the amount of depreciation alone will be recorded here under depreciation and amortization expense. The total amount will be recorded under statement of profit and loss. Okay, the next one is other expenses. Other expenses means, see, the expenses that do not find place in the above mentioned heads are brought under this head. For example, administrative expense, selling and marketing expense, carriage outwards, telephone expense, electricity expense, rent and rates, sundry expense. So these are the expense. You cannot record all these expenses in any other above mentioned topic. So all the expenses which is not applicable for the above heads, that will be recorded under this head, that is other expenses. So working note number 7 is other expense. The final total amount will be recorded under statement of profit and loss, working note number 7. Okay, so after recording other expense, now you need to find the total expenses, that is cost of material consumed, employee benefit expense, finance cost, depreciation and amortization, and other expenses. So find the total expense. Now you need to find the profit before extraordinary items and tax, that is total revenue. Total revenue, that is revenue from operation and other income, will be total revenue. So total revenue minus total expense is equal to profit before extraordinary items and tax. And after finding this amount, you need to charge and you need to make provision for taxation. After finding the profit before extraordinary item and tax, you need to charge provision for taxation. See, you cannot find the tax amount. Why? Because now you are preparing statement of profit and loss and balance sheet. So in this case, you are not in a position to know the exact tax amount, but you need to make some provision for taxation. The provision for taxation will be calculated on this amount, that is total revenue minus total expense before you charging extraordinary item. Okay, you need to calculate provision for taxation, and here you need to subtract extraordinary items if any. Extraordinary item means some non-recurring expense also will be there. If you find any unusual or extraordinary expenses incurred in that particular year, that will be recorded here, that will be subtracted from the profit. For example, loss on account of fire. If there is any loss occurred due to natural calamities or fire, flood, earthquake, so that will be called as extraordinary items, that is unusual transaction. In the same way, speculation loss or gain, this is also unusual. And salaries and wages paid for previous period due to agreements with retrospective effect. If there is any retrospective effect which you have paid in the last year, that will be adjusted here. So all these items are called extraordinary item. These are all unusual transaction. If you find any unusual or extraordinary item in the trial balance, that will be subtracted from the profit in the statement of profit and loss. Okay, after subtracting provision for taxation and extraordinary item, the final amount will be called as net profit for the period, that is profit or loss for the period. If you get positive value, it will be profit. If you get negative value, it will be called as loss for the period. Whether it is a profit or loss, this will be transferred to balance sheet. Let us see balance sheet revised schedule. See, in the balance sheet you need to write the name of the company, balance sheet of the name of the company as on 31st March every year. And here you need to write the contents of balance sheet, and here you need to write the working note number, and here you need to write the net amount of each and every content of balance sheet item. See, the balance sheet consists of two things. First one is equity and liabilities, and second one assets. See, the equity and liabilities again divided into three components. First one, shareholder fund, which is called as equity, and all other two things are called as liabilities. First one is shareholders fund. So, in shareholder fund, again we have three components. First one is share capital, second one reserves and surplus, third one money received against share warrant. These are the three items which is belong to shareholder fund. So, this is also one of the component which comes under equity and liabilities. And second one is non-current liability. So, non-current liability and current liabilities are liabilities which is not belong to equity. Okay, so under non-current liabilities, again we have four items, that is long-term borrowings, deferred tax liabilities, other long-term liabilities, and long-term provisions. So you can easily divide liability into non-current and current. Current liability means, so these are the amount you need to repay within 1 year, that is within 12 months. If you are supposed to repay within 12 months means which is called as current liability. If you need to repay more than 12 months means that will be called as non-current liability. So based on the repayment date, you can classify the liability into current liabilities and non-current liabilities. So under current liabilities, four items are there. That is short-term borrowings, trade payables, other current liabilities, and short-term provisions. So now I am going to explain each and every content separately. So the first one is shareholder fund. In shareholders fund, the first item, share capital. See, working note, that is notes to account on balance sheet. So all the working note will be recorded separately. The final amount will be recorded in the balance sheet. The balance sheet first item is share capital. See, while you prepare the working note for each and every content, under share capital you need to disclose authorized capital and issued capital also. Okay, put double line, and here you need to write subscribed shares and paid up shares. So shares can be classified into two categories. One is equity shares and preference shares. So if the company have both equity and preference means you need to record both the shares, that is authorized capital of equity and preference, and issued capital of equity and preference separately, and just put double line and then write the subscribed and paid up share capital. If there is any calls in arrears, that will be subtracted. If there is any forfeited shares, that will be added back along with the paid up capital. So this is the procedure to find the net capital amount. This will be shown under balance sheet under the heading of equity and liabilities. First heading is share capital. Second one, reserves and surplus. So reserves means amount set aside out of profit and other surpluses to meet future uncertainties. See, it is created to meet prospective losses or liabilities or to strengthen financial position of the company. So every year out of net profit, the organization need to maintain some reserves in order to meet future uncertain expenses, because future is always uncertain. Anything can be happen at any time. In case of any unexpected loss, that loss will be compensated with the help of reserve which is maintained by the organization. See, under reserves and surplus, first you need to write the general reserve if any. If you find any general reserve as opening balance in the trial balance, start with that and add additions made during the year. If the current year, if you find any adjustment regarding general reserve, that will be added back along with the old value, that is opening value, to know the total reserve maintained by the company for the current year. Okay, that will be recorded outer column. And apart from the general reserve, if you have any security premium, security premium means at the time of issuing shares, company may issue at premium discount or par. So par means same value, discount means lesser than the face value, premium means extra, that is more than the face value. So if they issue shares at premium, that extra amount will be recorded under reserves and surplus, that is security premium. In the same way, at the time of redemption of preference shares, company may redeem preference shares at par or premium. In case of premium, you are repaying extra amount than the face value. It is a loss, no. So that will be adjusted with the security premium which you are maintaining in the reserves and surplus. So from security premium, if there is any premium on redemption of preference share, that will be subtracted to know the net amount which is available in the reserves and surplus heads, that will be shown here. If you find any other reserves apart from the general reserve and security premium, you can write under reserves and surpluses, that is capital redemption reserve, capital reserve, debenture redemption reserve. These are all other reserves. Okay, if you find any reserves, that will be recorded under reserves and surplus. So find the total reserve and now go for surplus. Surplus means if you find any credit balance, that is profit and loss, it will be called as opening net profit, that is the last year profit will be shown in the trial balance. No, add net profit during this year. If you find any profit for the year, that will be added along with the opening profit. You can get the total profit. After finding the total surplus, if there is any appropriations like transfer to general reserve, I told you no, every year they need to maintain some additional reserves, so that will be calculated from the net profit. If you have any transfer to general reserve and final dividend, interim dividend, proposed dividend, all these amounts will be taken from the net profit only. So that will be recorded, subtracted from this profit. So all those items will be recorded under appropriation. It is just like a profit and loss appropriation account. See, the profit and loss appropriation account is maintained in order to show all the components which is taken from the net profit. So all the transfer entries will be recorded under debit side of profit and loss appropriation. The same thing only here, you need to subtract all the appropriations, that is transfer to general reserve, final dividend, interim dividend, proposed dividend. See, for interim dividend and proposed dividend, organization need to charge corporate dividend tax at 17%. So this is mandatory. Whether you find this information in the adjustment or not, you need to charge corporate dividend tax at 17% on interim dividend and proposed dividend. Whether this information is given in the problem or not, you need to charge this amount on interim dividend and proposed dividend. So that amount also subtracted from the appropriation. So these are the items will be subtracted from the total surplus. If you find any residual amount, that will be recorded outer column. Now you can find the total reserves and surplus. This amount will be recorded in balance sheet. See, the next one is under shareholder fund. First, share capital, reserves and surplus. These are the two things we have discussed. Third one is money received against share warrant. Working note number 3. Share warrants are the financial instruments which give the holder right to acquire equity shares. So these are all financial instruments which will be converted into equity shares at a later date at predetermined price. So till this considered as a money received against share warrant. In future date, there is a possibility of converting this into equity shares. So this is also, this amount also which is belong to shareholder. Now let us see the second one, that is non-current liabilities. Under non-current liabilities, 4 things are there. Long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. So the first one is long-term borrowings. Working note number 4. These are the things are there, that is debentures, it's a long-term borrowing, bonds, term loans, public deposit and other loans and advances. So if the borrowing is more than, you are going to repay these amounts after 12 months, means these are the things are called as long-term borrowings. So debentures, bonds, term loan, public deposit, other loans and advances are different components which comes under long-term borrowings. So this amount will be recorded under balance sheet. Next one is working note number 5. deferred tax liability. Every year, accounting income is compared with the taxable income. If you find any difference in that, you need to calculate income tax on the difference. Is termed as deferred tax. Okay, if the accounting income is greater than the taxable income means you will be getting deferred tax liability. If the taxable income is greater than the accounting income means the difference amount will be called as deferred asset. Whether it is a deferred tax liability or deferred tax asset, both are book entries only. Next one is working note number 6, that is other long-term liabilities. Premium payable on redemption of debentures and premium payable on redemption of preference shares. So when you pay any premium at the time of redemption of debentures and redemption of premium, that will be called as long-term liabilities, that is other long-term liabilities. So the total amount will be recorded under balance sheet. The next one is long-term provisions. If you maintain any provision for long-term basis, that will be recorded working note number 7. For example, provision for retirement benefits payable to employees. So you are making some provision for retirement benefit to employees for long run basis is called long-term provision. In the same way, provision for warranty claims. So if you maintain any provision for warranty claim, this is also long run basis. So these are the two provisions which is maintained by the company for long term. So these are the things will entered under working note number 7. Final amount will be recorded under balance sheet. See, next one is current liabilities. I told you no. So based on the duration, that is if you are going to repay the liability within 12 months means considered as a current liability. If it is more than 12 months means it is called as non-current liability. So based on the period only we can able to identify whether it is a current liability or non-current liability. So now let us see the current liability contents. So under current liabilities, 4 contents are there. First one, short-term borrowings. Second one, trade payables. Third one, other current liabilities, and the last one is short-term provisions. So let us see each and everything separately. Under working note number 8, short-term borrowings, bank overdraft. It is a short-term borrowings because you need to repay within 1 year. In the same way, cash credit from banks, deposits from the public, loan from other parties. So these are all short-term borrowings which you need to repay within 12 months. And next one, trade payables. So these are the 3 components which is related with the trade. That is trade creditors, sundry creditors, bills payable. So these are the 3 types of short term. These are the 3 types of current liability which is related with the trade. So this will be shown separately. And apart from these things, if there is any other current liabilities, that will be recorded separately under the heading of other current liabilities, working note number 10. That is outstanding expenses, income received in advance, outstanding interest on loan, outstanding interest on debentures, and unpaid dividend, calls in advance, PF payable, ESI payable, VAT payable, central tax payable. So all these items are short-term liability, that is other current liability. So this will be recorded under the heading of other current liability, working note number 10. And finally you can get the total other current liability. This will be recorded in balance sheet. Last one is short-term provisions. So company may maintain provision for long run and short run. If you find any provision for short run means within 12 months you are going to pay. Before that you are making some provision for short-term basis. So that will be recorded under the heading of short-term provisions, working note number 11. For example, provision for taxation which is maintained for 1 year only. In the same way, proposed dividend. So every year you need to declare dividend. This is also short-term provision. In the same way, provision for employee benefits and provision for expenses. So these are all called as short-term provisions. Now let us see the assets. See, assets are classified into 2 categories. First one is non-current asset. Second one, current asset. Current asset means so those assets which can be easily converted into cash within a short period is called current asset. So other than the current assets are called as non-current asset. So in non-current asset, again we have 5 components. First one, fixed asset, non-current investment, deferred tax assets, long-term loans and advances, other non-current assets. So these are the 5 components which comes under non-current assets. So the first one is fixed asset. The fixed assets again classified into 4 categories. First one, tangible asset. Second one, intangible asset, and capital work in progress. In the same way, intangible assets also under development. So if you find find any under development of capital asset, that is work in progress, or intangible assets under development, that will also be recorded under the heading of fixed asset. So let me explain the first one, tangible assets. The first one is tangible asset, working note number 12. So tangible assets are called as fixed asset, that is land and building, plant and machinery, furniture and fixtures, vehicles, office equipments, and other tangible assets. So these are all fixed assets that will be recorded under tangible asset. If there is any depreciation, that will be subtracted here itself, and after charging the depreciation only, the net amount will be recorded here, and after finding the total tangible asset, this will be recorded in balance sheet. Next one is intangible asset. So intangible assets are goodwill, brands, trademark, computer software, copyrights and patents, license and franchisee. So these are all intangible assets. So these are also fixed assets but intangible assets. So these are the examples of intangible asset. If there is any calculations like right of goodwill and right of patents and copyright, so all the calculations will be done here itself. The final amount will be recorded in the balance sheet. Next one is capital work in progress. Capital work in progress means tangible assets work in progress. So if there is a work in progress of tangible asset, that will be shown separately under the working note number 14. And next one, intangible asset under development. The same thing only, but this is for tangible asset, this one for intangible asset. Next one is non-current investment. So non-current investments are long run basis. If any amount invested in other companies, shares, debentures, bonds, investment in property, investment in equity instruments, investment in preference shares, investment in mutual fund, investment in government bonds, that is long term, and investment in partnership firms. So these are all investment made in other companies and shares and securities for a long run basis. So all these things are called as non-current investment. So working note number 16 is non-current investment. The final total amount will be recorded in balance sheet. The next one is deferred tax asset. I already explained, so there is a possibility of getting deferred tax liabilities or deferred tax asset. So according to the positive value, negative value, you can enter either liability side or asset side. Whether it is a liability or asset, both are temporary in nature. Okay, it is only book entries. Working note number 18 is long-term loans and advances. If the company provide any amount, okay, for outsiders as a long-term loans and advances, it will be recorded under working note number 18. So this is also one of the component of asset. And next one is other non-current assets. So apart from the other things, if there is any other non-current asset, that will be recorded in the 19th working note number 19, that is other non-current assets. For example, long-term trade receivables. So trade receivables may be short-term and long-term. If it is long-term trade receivable means that will be recorded here, other non-current assets. So far we have discussed non-current asset. Let us see current asset. So in current assets, again we have different components. First one is current investment, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. So these are all current assets which can be easily converted into cash within a short period of time is called current assets. The first one is current investments. Current investment means those investments which are held to be converted into cash within a short period is called current investment. Okay, for example, investment in preference shares, investment in equity instruments, investment in government or trust securities, investment in debentures or bonds for a within short period is called current investment. Next one is inventories. Working note number 21 is inventories. Inventories are classified into three categories now, that is raw material, work in progress or finished goods. If you find any closing stock, enter here. And stores and spares, loose tools net. So after finding the difference, that is depreciation, the net amount will be recorded here, and goods in transit. So these are the different components of inventories. So goods can be in transit. Okay, so these things will be recorded under the heading of inventories. The final total amount will be recorded in balance sheet. Next one is working note number 22, that is trade receivables. Trade receivables are bills receivable, debtors. If there is any provision for bad debts and provision for doubtful debts, that will be subtracted from the debtors and the final amount will be recorded here. That is bills receivable and debtors or trade receivables. This will be recorded in assets. The next one is working note number 23 is cash and cash equivalent. For example, cash in hand and cash at bank, that will be recorded here directly. If there is no adjustment, means you need not have a separate working note. Directly you can write here itself cash and cash equivalent. In the same way, short term loans and advances. If you provide any loans and advance to others as a short term basis, that will be recorded under working note number 24. And the last one is other current asset. If any asset which is not applicable for the above mentioned topic, that will be recorded under other current asset, working note number 25. Finally, you will be getting equal amount of total assets and total liabilities. This is the procedure to prepare the company final accounts according to revised schedule number 6. If there is any adjustment regarding any item, that will be done in the working note itself. Here in this format, you need not show any adjustment. Here you need to record only the final net amount for each and every content of balance sheet. Hope you all understand this concept. We will see the final account problem with adjustment in separate video. Thank you.